What is the difference between financial accounting and tax accounting? I wanted to go over high level why there are differences between financial statement and tax returns. So in America, when you are preparing financial statement, you're either relying on US GAAP or IFRS. GAAP is generally accepted accounting principle. IFRS stands for International Financial Reporting Standard. And tax return is prepared based on Internal Revenue Code section. So therefore, there are some difference between financial and tax accounting in the US. So financial accounting, when you're looking at how to get to your net income, you start with operating income minus cost of goods sold, which will lead you to gross profit, and minus deduction, that will give you net income. And after that, you may have unordinary income or unordinary expensive that will give you net income before taxes. And income taxes deducted, and the bottom line would be net income after taxes. That's your financial accounting. In a tax accounting, it's very similar. So you start with income minus cost of goods sold equal gross profit minus deduction, which give you taxable income. And once you apply income tax rate, you will get income taxes. And if you are entitled to tax credit, you can deduct tax credit from income tax you pay, so that will be your total tax due. So the overall, it looks very, very similar, but what is the difference between GAAP, IFRS, and IRS tax section? So difference between financial accounting and tax accounting are grouped in two different ways. In the tax world, we will call permanent or temporary. So permanent means it's deductible in one, either financial tax accounting, but other side you cannot. So as an example, muni bond interests are deductible for, are included in the financial accounting, but some cases in tax accounting, muni bond is not included. So looking at the business expense side, for example, deduction, meal and entertainment, gift and taxes are deductible in a financial accounting. However, there is a limitation in the tax accounting. So for example, if you're looking at meal and expenses, typically 100% is deductible on the financial accounting side, but meal is typically 50% deductible in the tax accounting. So that creates permanent differences. And temporary differences are just difference in the timing when you can deduct those expenses in financial accounting purposes and tax accounting purposes. So the big one is accrued income, and for the deduction side, you will also have accrued expense or depreciation. So as an example, depreciation, typically financial accounting, we use straight line method, which is just averaging out those depreciation over the life of assets. For tax accounting, you may be elected to do 179 election so that you can deduct all the depreciation on the initial year up to $250,000 currently in 2022. Above and beyond that, you have to use double declining balance, DDB, so you depreciate faster than financial accounting. So those are kind of like an overview of like why there are differences between financial accounting and tax accounting.